Hello, welcome to the episode on the Let Fuel Prosper series. My name is Dr. Vance Ginn. I hope you're having a prosperous day. Well, today I'm delighted to have someone on who knows a lot about the financial system, a lot about the economy, and just so much more. And you've probably seen her on TV many times as well, but it's none other than Dr. Judy Shelton. Judy, welcome to the Let Fuel Prosper show.
My pleasure to be with you. Thanks for inviting me.
Well, it's really a pleasure to have you on today. I know we have a lot to talk about, so I want to get straight into it. But first, for the audience, let me go ahead and read a little bit of your bio, and then we can jump right into our discussion today. So, Judy Shelton is a senior fellow at the Independent Institute, former chairman of the National Endowment for Democracy, and former U.S. director of the European Bank for Reconstruction and Development. She has testified before the U.S. Senate, Foreign Relations, House Banking, House Foreign Affairs, and Joint Economic Committee. Shelton has been consulted on international economic and financial issues by national security officials at the White House, U.S. Congress, and the Pentagon. She received a postdoctoral fellowship from the Hoover Institution at Stanford University as a national fellow, and she was named as a Hoover Senior Research Fellow. She is the author of The Coming Soviet Crash, Gorbachev's Desperate Pursuit of Credit in Western Financial Markets, and Money Meltdown, Restoring Order to Global Currency System. Her popular articles have appeared in the Wall Street Journal, Financial Times. She's also on Fox Business and Fox News pretty often with Larry Kudlow and others. And she holds a PhD in business administration with an emphasis on finance and international economics from the University of Utah. So with all of that, Judy, great background, always a lot of good discussions. I'm excited about having this discussion today. Before we get into all the nuts and bolts, what motivates you to do what you do each and every day?
I would say that I'm motivated to concentrate on monetary policy from the viewpoint that I see money as a moral contract between the government and its citizens. I think that money has to serve as an honest measure, and without that, people really can't enjoy the economic liberty that we are supposed to have under our founding principles, and that I think is the best way to optimize the outcomes of free market interactions. So I feel very strongly from a moral sense that it is a policy issue worth fighting for, and I enjoy being at that nexus of theoretical and reality, of trying to combine scholarly theory with the way the world really works. So for me, it's a very exciting field and one that I feel is worth every effort I bring to it.
Well, and you've had so many opportunities to bring forth that knowledge and that wisdom that you have and the connection between these in different aspects, whether it's on hearings or, to a popular audience through the Larry Kudlow show or something along those lines. So I really appreciate all the work that you've done there. And, just real quick, my motivation is really to let people prosper. That's kind of been my mantra for a while. I believe it's my calling to do. And that's a part of making sure that people are able to prosper, not only materially, but also spiritually, intellectually, socially, just all the different ways. I'm a classical liberal. And so I find myself being on, let's try to get government out of the way as much as possible when it comes to money and other things. And I wonder, though, like with your emphasis on money, which I think is so important, it brings us all together through exchanges. Where do you usually like to start? Like when you're telling somebody about money, where do you like to start?
Well, that's an interesting question. I wrote a booklet. I think they published about 100,000 copies for Freedom Works going back a decade or more. And I started with saying, pull a dollar out of your wallet and look at the symbols and what does it mean? And I guess that's where I would start. Why do we believe in this paper currency? And why do we accept it for all of those primary functions of money? That is to serve as a unit of account and a medium of exchange and a store of value. So I start with that. And then I think it's reasonable to question how well is the US dollar living up to those functions, those purposes of money? And how can we ensure that it continues to provide those basic measurement functions and store of value functions without having that impinged upon by government's tendency to provide services to expand government power, I think quite often at the expense of the private sector. And I agree with your philosophy. I think to let people prosper, you really just want to give them the tools and then not burden them.
Exactly right. And I like the way you put that too with the dollar. And it's interesting because the dollar, or just a currency in general, brings us all together. I think oftentimes when I was teaching economics, I'd ask the class, hey, what does economics mean to you? And they'll say the dollar, the stock market, something along those lines, just the banking system. And I was like, look, but it's really about human beings. It's really about the study of how humans act and interact within institutions to satisfy our desires given scarce resources. That's kind of how I like to define it. And money brings us all together. No matter if one is black, brown, white, if they're Christian like me or not, or other sort of demographics, it brings us all together because of this mutual benefits of exchange that allow us to come together. And there's something kind of beautiful about money in that way. What do you think about something like that?
I think that's beautifully described. I really like the way that you just explain the importance of money, because we're talking about voluntary transactions between individuals. And using money, it has to be accepted on both sides, and that involves trust. And humans trusting each other is a very good thing. And,
Yeah.
and I likewise believe in a peaceful, prosperous world and letting people pursue life, liberty, and happiness. And
Yeah.
for a lot of people, prosperity for themselves and their family is part of that happiness and part of the dream they wish to pursue. So I think they deserve an honest measure so they can plan, and so that the free market system works best for them and optimizes the outcomes.
It's well said there, Judy. And there's a lot of things that I want to go through today. One of the things that I would like to first touch on is we both talked about this view of limited government, getting government out of the way as much as possible. That way, we have the liberty and prosperity that we otherwise should have. And today, I see that government is growing so much in so many different areas. I mean, it's stifling the housing market with rules and regulations and everything else that's going on. We see government spending, $7 trillion over the last few years. That's led to a national debt sort of situation, interest rates, soaring, inflationary crisis that's happening. I think part of it is because there's a lot of micro level factors to that. But at a macro level, I think with institutions being so important, we've lost sight of what capitalism really is, in my view, of how it is limited government. I'm not an anarchist or anything like that. I do believe in roles for government. But there are also the markets that need exchange within people so that people own and have control over their capital and their labor. And too often I see that we've moved more into a socialist sort of tendency across the economy, especially under the Biden administration. And I'm a little worried some by those on the right who would like to add more government in certain areas than others. But I wonder where you're seeing this now with this. Is it capitalism? Maybe we've lost sight of it. Is there something else that's happening?
Well, I think that there is a tendency to have more government. We know power corrupts.
Yeah.
And I cut my teeth when I was back at the Hoover Institution at Stanford, looking at the Soviet internal monetary and financial system. So that dates me. But I think it provides some lessons, because when you have a Soviet central bank, and that becomes the basis for central planning, then you see that everything is done to fulfill the government's expectations of what needs to be done, instead of allowing innovation and creativity to create new levels of prosperity that no government bureaucrat would ever be likely to come up with. So I think it's very important that money not be a tool of government economic planning, but to serve the need to have a reliable measure and a dependable store of value and a meaningful unit of account for the people who actually use the money. And capitalism, to me, is a beautiful way to allow people who have an idea to seek funding and hopefully be able to finance it by convincing people that they have the character, they have the competence, they have the vision to carry out their plan, and that it will yield not only enough to pay back the interest rate, which should be determined by supply and demand for loanable funds, not by a central bank, in my view, not only to pay that back, but to generate a greater future harvest. That's why it's worth it for people under capitalism to say, I am willing to sacrifice consumption today because I believe it will lead to a greater harvest in the future. So the seed corn is needed now to be put aside. And to me, capitalism serves the creative entrepreneurial instincts of people and allows those who recognize the potential that can come from that sort of productive investment to be their partners. And I like that very much. When government not only controls the cost of capital through the central bank, but encroaches on the integrity of the monetary unit itself through fiscal policy, then I think we're really having the whole capitalist system compromised by the inability of government to discipline itself sufficiently to not taint the unit of measure, to not undermine the integrity of the monetary unit. And so monetary policy is very much connected with fiscal policy in that regard. And they both need to be disciplined to preserve the monetary unit as a meaningful, honest measure of value.
I agree. And I agree with you too, that we don't need a central bank. I would rather the Federal Reserve not exist and allow for a free banking system or something else, or backed by gold or something that allows for that unit of account and a medium exchange to be much more credible than what it is today, than backed on a fiat system of debt. And so there's some incentive in place for us to keep running up massive debt, because for a long time, it seemed like there wasn't much cost to it. You know, the 1%, 2% inflation, interest rates, 0% are very low. But now we are starting to feel more of that cost over the last, year, let's say. And inflation is all around us. I mean, in some, at least if you look at CPI, I guess it's around 4% now, but there's still underlying levels of inflation. And that's just for the average urban household, much less what you feel in other places, depending on what the rent is and other things, which it seems to me like there's been too much money created, too much money chasing too few goods, as Milton Friedman would say. You have inflation, and we continue to see that. And Judy, I wonder where you were on this. We had this experiment over the last couple of years where we had the shutdowns, and during that time, so from June of 2019 to May of 2020, I was in the White House. I was the chief economist for the Office of Management and Budget under Russ Vought. I helped write the president's last budget where we found $4.6 trillion in savings, which nobody really looked at afterwards. And, we also had the situation where COVID came in right at the end of my time, and I found myself in the Situation Room having these discussions. And I was always one of the ones who was saying, look, we don't need to shut anything down. The entrepreneur needs to be a part of this. And then you had this situation where all this new spending came online, and the Federal Reserve monetized a lot of that through their purchases and more than doubled their balance sheet. And it was just phenomenal to me to see that so many economists were thinking that this was going to be transitory inflation, or no inflation, as they initially said. But to me, it was always going to be persistent inflation if you put that much money in the economy and you're stifling supply by regulations and then higher taxes by the Biden administration and everything else. And the supply chains were basically shut down as well, that this was going to be a lot longer lasting. And I think it puts less credibility on the Fed and our fiscal policy, in Congress here in the United States, which is weakening our global reserve system as well. But I wonder what your kind of thoughts were throughout the last couple of years.
Well, I would say you were pretty clairvoyant if you saw back then in the spring of 2020, when people were near panicking because they didn't understand COVID. At the time that the Federal Reserve unleashed its massive program of quantitative easing and special lending programs, and at the same time, fiscally, and with the approval of Congress, Treasury was sending out checks. A lot of them have proved to have been given to fraudulent receivers and shouldn't have been. But people felt like, since they were being asked to do something virtually unprecedented, just stay home. I won't get into that debate. I think there's a lot of people now think that was a big mistake.
Right.
But at the time, it was seen that the Fed had to take everything it ever had off the kitchen shelf and sort of deploy the airbag to keep the economy from being destroyed, because it was clearly going to crash. And the problem was, at some point, you have to get the car back on the road. And that's where I think it was bothersome to me to see the Fed resisting that. even when the emergency seemed to be alleviating and it was time to try to get back on the road, the Fed, even under pressure from Treasury, because I basically was still working for Steve Mnuchin as
Mm.
Treasury Secretary.
Hmm.
And so I was watching, I was a nominee at that point, but all of my service in the Trump administration had been through the Department of Treasury. And I saw that he was saying the original program set up to make payments available to people was meant to be just for the emergency and to be closed out. And so the Fed should likewise be doing that. But at that point, I think the Fed was looking at a new incoming administration in late 2020 and suddenly seemed to be more open to the arguments of Democrats who thought, well, maybe some of these big programs are working out just fine. Let's keep it up. And this is a problem. We
Yeah.
already touched on it with power corrupts. Whenever the Fed has faced these crises, you can look at 2008, which I think was largely the fault of the Federal Reserve. Certainly no other government institution had more responsibility or more power to properly calibrate money and credit to the needs of the economy than the Fed. And something went way wrong in 2008. So the Fed is never suitably humbled, or if they are, they don't see that as a reason not to expand powers. So we see the Fed reluctant to give up power. I believe they added 5 trillion between March 2020 and 2 years later. And it's been fairly slow on the quantitative tightening. Plus, there was a little bit of lending after Silicon Valley Bank. But the Fed is presumably trying through runoff to reduce its portfolio, which hit 9 trillion. But it's always much slower to give up the resources than it is to grant itself emergency powers. And it's too quick to then reuse anything that it ever saw as working. I think that the Fed should have been trying to deal with the obviously unleashed liquidity much sooner. So I was arguing, I think in the summer of 2021, that they needed to start raising rates. I thought we needed to normalize. It's the zero interest rates going on forever that distort the system. It was mostly fiscal transfer payments, in my view, that were feeding the immediate inflation. And then the Fed only reluctantly trying to curb the excess liquidity. But instead of doing it by paying interest on bank reserves and starting the reverse repo market, I think the Fed should have immediately began not just using runoff, but selling back all of those Treasury securities and mortgage-backed agency securities that it had purchased. I think the Fed should have immediately been trying to use open market operations, not paying administered rates on cash, to reduce that liquidity and to normalize. I was happy to see rates go up right up until about 4.5% last December. And I think markets were happy. In fact, the stock market started coming back because I think they saw some semblance of normalization. The riskless rate, we'll call it the Fed funds rate, should be around 2.5. And then if you add in the Fed's inflation target of 2, I think it should be 0, but let's accept their 2% even. Then at a 4.5% roughly Fed funds rate, then they should stop. Let the market make the rest of the adjustments. The worst of all worlds, in my book, is for the Fed to keep having such a prominent, such a powerful, and such a political influence on markets. And they should have been trying to reduce their footprint, and they should have stopped, I think, raising, because now I think we're past the sweet spot. Now I think that when the Fed keeps raising interest rates, that is not going to cut inflation. If anything, it adds to the cost of business because it adds to the cost of capital, working capital for small business. So I think that's a mistake. I just want the Fed to stop. And the day that the market quits trying to predict when they're now going to lower rates, that's what bothers me. They just leave it and then let the market react. And that's the way you'll work out the rest of the excess liquidity.
Yes. No, I agree with you. I think that they should be contracting, selling off more of their assets, more of those treasury securities, and contracting their balance sheet at a much faster clip than what they are now. I think the latest that I saw, they're down about 5% year over year, maybe 6%, right in that range year over year. It's also interesting too, because like the M2 money supply, kind of the broader range of the money aggregates, is down about 5%, which is about the most since the Great Depression. Both of these, I think we had a slight decline in 2011, 2012 there, as well as at least in the balance sheet when the Fed started to sell off some of those assets then, or at least let them mature. So you've got to look a long way back before you can do this. And I have some folks, who people I've had on the show who have been kind of concerned about how quick that is. And, will it be enough, or did they not have enough already? And look, it will lead into a deflationary period, but I don't think that's the case, given what's already going on in the economy with a lot of underlying inflationary pressures. And whenever you come out and you more than double the balance sheet, yes, it's coming down 6%, but that was after a massive increase in their balance sheet that's still out in the economy. And Judy, I'd love to hear some about your background on which schools that maybe helped you get your views, because I really like where you're going with this, like the 0%. They should really have 0% inflation. Mine is kind of a combination of the Austrian school. I think they explain the economy really well in a lot of ways. I'm for ending the Fed and that sort of thing. But I've also been, learned a lot from Milton Friedman and the monetarist school, the public choice economics with James Buchanan, and institutional economics with Douglas North. That kind of rounds I just call it free market economics. I think they all go together that way. But some of the talking points that you had there, I heard a lot of the things that kind of fit into a lot of those. But I wonder kind of what's your background on the economic schools of thought.
I would say the Austrian school would be predominant for me. I would call myself more a follower of Robert Mundell,
there you go.
who I got to know quite well and ended up co-chairing with him his annual International Monetary Conference in Italy every year. Milton Friedman's office was about 3 minutes away from mine. We were both senior research fellows at the Hoover Institution. Milton, of course, on domestic monetary issues, I thought was quite good. I was more of a Mundell follower on international. I thought a fixed rate system is much better. I continue to believe that, and a roll for gold than Milton's approach. And mostly because I think Milton Friedman's views are somewhat misunderstood on international. I mean, if you could have a free market in currencies, that's something way different than what we actually have. He didn't like a pegged exchange rate. Milton Friedman, of course, is the guy who went against the Bretton Woods system and said we should have flexible, freely floating exchange rates. But in fact, when you have governments intervening, a dirty float was another thing Milton hated. And the system we have today, which empowers central banks, would be completely against anything he would favor, because it's empowered government to direct capital. So the monetarist school is very interesting, and certainly there are many aspects of it that I think are quite important to be aware of. But I would say things have changed. But for one thing, the weakness in the monetarist formula derived by Milton Friedman, and he used that was his license plate.
Yes.
That formula.
MV equals PY.
Exactly right.
Yeah.
But it's the V part.
Yeah.
It's the velocity. And the velocity is not constant. He assumed it was constant. Mm-hmm. And so velocity has changed. And I think it's because if you look at the monetary aggregates, it's the vastly enhanced percentage of the money supply that is made up of base money, because all of that cash, all those reserves are base money. But because the Fed is paying now through administered rates, not through open market operations, the administered rates are coercing that money to sit there doing nothing. So there's no multiplier effect. There's no velocity. That money is not buying anything. It's not financing anything. It's sitting there gathering interest for doing nothing. I think that's extremely unhealthy. Whereas when you used to look in the Paul Volcker days at M1 or M2, that would be the impact of banks making loans. And then those loans had the multiplier effect, because they created purchasing power. People then had loans created for them. They would go into the bank and draw down those loans. So that was money created by banks, but at least that's healthy money, presumably going into productive investment. What you have now is, I think, the Fed luring that money to sit stagnant And that's at the expense of productive endeavor. But that's why I think we have to be careful looking at the monetary aggregates, because each one, as you go up to M1 or M2, you're building on that base money, M0. And it's the base money that is now over 5 trillion. And it versus in Volcker's day, all he was really trying to do was raise the interbank rate, raise the interest rate that banks paid each other to borrow money so that they could keep their loans outstanding. And if that got too expensive, they had to start calling them in. That's a far different way, a different mechanism than the way the Fed attempts to affect the money supply today. And when you say zero interest rates, I guess that's from the Alan Greenspan school. It's very interesting to see. You have to go back to the transcripts of the Federal Open Market Committee from July 1996. But to listen to the discussion of Alan Greenspan and Janet Yellen, who was arguing, kind of using research by her own husband, who was quite a monetary scholar, but his attitude was Keynesian and saying, you have to use money illusion. That if, let's say there's a downturn in growth, you don't want to cut people's nominal wages. And so if you're going to give them a 1% raise, then you have to have 2% inflation, because you really have to reduce the real wage by 1%. So it's all based on thinking people are kind of dumb and that they don't understand that it's a net loss in real wages to them. And yet she convinced Greenspan, who said maybe it should be zero. When you look at our charge from the dual mandate of price stability, how can that mean anything other than stability, zero? Right. It doesn't mean stable inflation. That's kind of an oxymoron. And it was only Jerry Jordan, who I would say would align himself with the Austrian school, who said, wait a minute, I don't understand why we're having this conversation, and I don't think Congress would like it. And it turned out they didn't want Congress to see those transcripts for a while. They were also concerned. They didn't think that would be seen as carrying out the mandate of price stability. But Jerry said, if you were to ask the American public, would you rather that the dollar lost value by design by 2% or 3% over the next 50 years? I think the average American would say, why does it have to lose any? Why can't it be a monetary standard, a store of value? Yeah. Why does it have to have programmed obsolescence in terms of purchasing power? Why isn't that government expropriation of private property? Because you earn your wages and you own your assets. And you even own those dollars. But if you put them under your mattress, you're guaranteed to incur a loss without due process by the government.
It's sad state of affairs. And what we've also seen is that what I believe it's allowed for Congress to spend more than they otherwise should. I mean, we're running up massive. I mean, to me, it all comes down to spending to some extent. I had John Cochran on, so he had talked about the fiscal theory of the price level, which makes a lot of sense to me as well. There's some issues I had that we talked about, but I think in general, if Congress didn't run up so much debt, then the Federal Reserve wouldn't have as much ammunition to throw at the economy, right? There would be, right? I mean, they could go out and buy other assets that they wanted to, like they do with mortgage-backed securities. But had that debt not been so high, $30+ trillion, $32 trillion now, that would give them less ammunition for monetary policy, wouldn't it?
Definitely. And no, the Fed is way too accommodating to do that. And by keeping the rates so low, the last piece I did for the Journal, and they ran it the day of the last FOMC meeting, I think it was June 14th, maybe. It was to say that the debt ceiling crisis had just been resolved, with the idea that the Republicans were saving, it was a fairly small amount of money over the next 10-year budgeting, which you would know all about, having been at OMB and had such an influential position there. It was minuscule savings, but it was something. They were starting to say, we've got to cut spending. But the difference, that 5% increase in interest rates over a 2-year period from what was projected as the cost of servicing the debt to the latest projections was mind-boggling.
Yeah.
I mean, it went from 5 trillion to 10 trillion. It was over the expansion of the 10-year period. And I just thought, this is unbelievable, because when rates were low, there was a sense, and I heard government officials say so, well, we should borrow because it's so reasonable. and or as a percentage of GDP. But once you start raising that interest rate, and then all of the new debt and all of the debt being refinanced comes up, it's so immediate and so overwhelming, and so all of these other savings that you slave away to find are just completely trivialized relative to the expense of servicing that debt.
Yep, that's right. And we're recording this on July 10th, and I'll put that on the show notes and everything too, just to make sure that whatever happens the next couple of weeks or anything else, there's always something that's changing. What I've been thinking about and writing a lot about here recently too is how, we stopped raising our interest rates. There's a pause. There's an expectation that Jay Powell and the FOMC will come back in and continue to raise rates. And I kind of agree with you. I don't think that that's going to necessarily influence inflation. They've really got to get control over their balance sheet, bringing down that balance sheet versus the interest rates. But we have seen our other countries, the ECB, Bank of England, and others, Turkey, all these other banks are continuing to raise their rates, what has put downward pressure on the dollar for depreciation, even though it has been, appreciating for a while. I think we were doing better than others just because others were so weak. And so it makes us look better in the process. And in kind of wrapping up here, Judy, is that, with the Biden administration and all these big bills that have been passed, uncertainty has been maybe higher than ever before about what the future is going to hold when it comes to regulations, which just like more and more all the time. I mean, there's some great work that's done by the American Action Forum, where they look at what the cost was under different administrations. And I think it's over $300 billion now by the Biden administration compared to the Trump administration, which was less than $100 billion. Because we were trying to rein those in quite a bit at the time,
Right.
but then you have the tax hikes with the Inflation Reduction Act that comes in, so that's another cost of doing business. You have the higher wages that are coming out, and by the way, average weekly earnings are still down for 27 months year over year, basically since the American Rescue Plan Act was passed. That we've seen that. And it's kind of one thing after another where American families are just, where do I go next? What do I do? Is the affordability crisis, and there's just no restraint being done at the federal level. I'm really big on fiscal rules. I think that's an institutional thing that's really important, like our Constitution, but also a spending limit, I think would be a better approach than maybe a balanced budget amendment. Balanced budget amendment would be great, but I just worry that they'll raise taxes instead of focusing on the true problem of government spending. And then I think with that, I've written some with Alex Salter on this about, I think that should be paired with a monetary rule, because if you don't have the fiscal rule, then you have monetary that may go out of control. And if you have a monetary rule without a fiscal rule, I think that will go out of control. So you kind of need a balance on both, just given what we've discussed here already. But I don't know that there's going to be the appetite for that anytime soon. I mean, even with this debt deal that was done, which really didn't do a whole lot, to be honest, there was so much pushback about how you can have all these big cuts and everything. And I think we do need to reform Social Security and Medicare and before the long-term trajectory continues to go, because we can't fund $2 trillion deficits every year and interest on debt being $1 trillion. I mean, that's just unheard of. Kelly, you said mind-boggling. And I'm also, last thing here is I'm worried about the global reserve currency of the world. If China and other countries are selling off the dollar and our assets, that's going to lead to a depreciation of the dollar, making it more costly for us to import goods and services. That puts upward pressure on prices. And I'm throwing a lot at you here at the end, but I'm pretty concerned about the future of the country, and I wonder what you're thinking about this.
Well, there's a lot to worry about. I definitely am a Ronald Reagan supply sider type person. I think the most promising area you touched on is if we can do what happened under President Trump and cut regulation. That's huge. There's another thing. I mean, even that moral aspect, it's just unconscionable to burden people, to make everyone subject to making a mistake, to have such complex and I think bureaucratic rules imposed that don't have a cost benefit analysis attached to them. I think taxes should be low to give incentives to work and invest and save. I think the third aspect is energy development, because that's been part of the inflation calculation. But also we need to play to our strengths. And so I think there are geopolitical reasons that we should have pursued that. And that also overlays with the less regulation environment, but a stable dollar, a stable, dependable dollar. I'm not someone who pushes for a strong dollar or a weak dollar. I don't think it should be a factor. I think you want to have comparative advantage work based on everyone understanding the unit of value. We do need to safeguard the integrity of the dollar. I don't like when other central banks, particularly the European Central Bank, use interest rates to get a trade advantage. I think central banks can be considered currency manipulators, and I think that's a mistake. To fight that, again, I would have pushed for ending the practice of paying interest on reserves, because right up until COVID started, we still had the European Central Bank deliberately keeping its rate negative. And a lot of the money from European banks, foreign-owned banks that operate in the United States, they were only too happy to just park their cash at our central bank. So now the rates that the Fed was paying, which come at the expense of taxpayers, we're going straight into these foreign-owned banks. So I think there are many reasons to end that practice. But we do need to safeguard the value of the dollar and be aware of these attempts by other countries to go around it. We may see some new things breaking, and I think we're going to have to respond to reasserting the global dominance of the dollar for the right reasons instead of some of the residual reasons that have kept it aloft this far.
Yeah, it makes a lot of sense to me. And I mean, we need to let markets work. That's how we let people prosper at the end of the day. And as we're wrapping up here, Judy, what else would you like to mention as we close?
I think I would reiterate your message. Let markets work. Let people prosper. That's the definition of true economic liberty. Guard against government encroachment and understand that the essence of, I think, the human experience involves free will. And I think morality can only be a personal act. What I want from government is rules of the road. I want justice in terms of applying the concepts of equal under the law and equal opportunity. But I leave mercy up to individuals. And I think you'll find that those filthy rich capitalists that people like Elizabeth Warren want to put a target on their back are some of the most beneficent, generous, charitable philanthropists out there. And I'm on their side. And I think Americans have traditionally not had grievance against successful people. They've just wanted to have their own chance to be successful and pursue happiness. So I hope we get away from this kind of warfare amongst ourselves and want everyone to be successful. And you're certainly doing more than your share to elevate that concept.
Well, I appreciate that, Judy, and same to you. Keep up the great work, and God bless you and your family. I hope
Thank
you continue to prosper in so many ways. And I'll be sure to put these other things in our show notes pages as well. But it's really been a great conversation. I know I've learned a lot, and I'm sure the audience has as well. Keep up the good work, and we'll see what the next administration is and who's all in there and everything as well. Should be fun.
Thanks. And thanks for all your work, and thanks for having me on today.
Okay, great. Well, thank you so much, Judy. And for the audience, please go and share this. Give us a 5-star rating if you would, if you enjoyed this conversation. And you can find this, the show notes at vanceginn.com or vanceginn.substack.com and all the platforms you can get your podcast. So please share that as well. So until next time, let people prosper.